Ford and GM are at the epicenter of the increasing trade barriers implemented by President Donald Trump and the current administration in the United States. Many investors are asking me now, which one of these two American car companies is the better stock to buy? I'll answer that question in this video, comparing these two on critically important financial metrics like revenue, profit margins, and return on invested capital. And I'll share with you my fair value calculations for this business and compare them to the current market prices of these stocks to determine which or if any of these two are undervalued at their current market prices. I'll do all that in this short video, so let's get right into it after a brief message from my sponsor.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/parkev for the 10 best stocks to buy now.
Right, so the first thing I wanted to compare these two on is revenue and revenue growth. And I went all the way back to 2016 and noticed a couple of big things about these companies, notably the volatility in car sales. That's to be expected. These are cyclical businesses. When you go and get a job, you get a new job, you're more interested in buying a car. If you get fired or if you're in fear of losing your job, you're not going to go shopping for a car. So, car sales are highly correlated to macroeconomic growth. When the economy is doing well, people are buying more cars. When we go into a recession, people are buying fewer cars. And so, businesses like Ford and GM experience those ups and downs. However, over the previous decade, they've increased their revenue to $173 billion, up from around $140 billion. In this time, they've grown revenue at a compounded annual growth rate almost identically. 2.3% growth for Ford, 2.4% growth for GM. Very slow growing businesses. These are mature industries. The number of car sales are increasing worldwide, yes, to be sure, but Ford and GM are losing market share to international competitors, especially from China, as that country's been able to gain significant market share in the car industry as they've capitalized on the electric vehicle industry and gained significant market share, able to produce lower priced EVs and lower priced cars overall, while Ford and GM are losing competitiveness, especially in regions outside of North America. The next thing I wanted to compare these two on is operating profit margins, and these are not high margin businesses. I've talked a lot about how car companies and car manufacturers are not attractive investments because of the factors surrounding these businesses. Large capital expenditures required, heavy intensity in competition, and it's getting even more fierce. An industry that's oversupplied with large exit barriers. And all of that, coupled with the fact that the companies in most parts of the world have poor negotiating power against the workers, which oftentimes come back over and over and over again and demand higher wages and receive them most of the time. So that's led to an unattractive industry. You can see here 5.5% operating margins for GM, just 1.6% for Ford, and these margins are declining for several years and they're likely to continue declining, especially as they will have to pay a higher price to import goods. Even though they're US manufacturers, they still import many components, machinery, etc., steel, aluminum, all of that. The companies will have to pay higher prices for these, and they have manufacturing facilities outside the United States as well. Ford and GM are not going to, it's not like a clear benefit to them to have higher tariffs on outside car companies. I also wanted to compare the return on invested capital. And again, you see the unattractiveness of the industry overall. 3.4% ROIC for GM, 0.9% for Ford. Going back a decade, you can see this is about where these companies are at. This isn't like a one-off situation where the ROIC or the margins are lower than usual. This is the typical margins that these companies operate with. Unattractive industry. Again, I can't emphasize the importance of investing your capital in industries that are attractive. A lot of times, investing in the right industry is more important than investing in the right company within the industry. And I've been talking for at least 5 years about how the car industry is not attractive and how especially electric vehicles are even worse than cars overall. Thankfully for GM and Ford, one of the positives is the current administration in the United States is no longer forcing companies like Ford and GM to produce electric vehicles at levels that consumers don't want to buy. So less than 1 out of 10 consumers are buying EVs in the United States. And I figured that number will be much lower without all of these interruptions from the government where they're forcing manufacturers to produce more by penalizing them for not having enough electric vehicles, forcing them to pay pure EV companies for credits. All of that looks to be going away, and that's going to benefit Ford and GM because they can produce the cars that people want to buy and sell them more attractively at better profit margins. That's going to be beneficial for Ford and GM. So now let's look at valuation. I calculated a fair value for these businesses, and Ford looks to be selling at a fair value, not too expensive, not too cheap. $11 intrinsic value compared to the current market price of $11.42. Similar with GM, selling at a selling at a market price of $57, intrinsic value of $54. Applying a margin of safety, this stock also looks fairly valued. But if I had to pick just one of them, and you forced me to pick one of them because I wouldn't want to own either of these companies right now. But if you forced me and I had to pick one, I would pick GM as the better stock to buy today. Hey everyone, I'm excited to announce that my book is finally available for sale. I've been working on it for more than a year now, so I'm really excited to finally share this with you now. It goes through my framework for evaluating stocks. Some of you often ask why I like this stock or why I like the other stock, and this framework provides you the things that I look at when I'm evaluating stocks. I've added the link in the description below.